Markets can stay irrational longer than you can stay solvent. That idea is the foundation of this episode, because every investor eventually faces a market that makes no sense, where prices rise on hype and fall on fear. The goal isn't to predict those swings. The goal is to survive them and keep compounding when others fall apart. Most investors waste years trying to forecast the future. Smart investors simply learn to read the present. The great investor Howard Marks calls this taking the market's temperature. You don't need a crystal ball. You only need to observe how people are behaving right now. Are weak companies raising money easily? Are lenders dropping their standards? Are people buying stories instead of earnings? Those are signs of heat and risk. When optimism gets excessive, tighten risk. When panic dominates, get ready to buy. Back in 2008, Oak Tree Capital didn't predict the financial crisis. They simply prepared for it. While others borrowed aggressively, they raised cash. When panic hit, they were able to buy $1 billion of distressed assets each week. Their logic was simple. If the system collapsed completely, nothing would matter. But if it survived and they hadn't bought, they would have failed their job as investors. That's the real lesson. You don't need to know the future. You just need to be positioned to act when opportunity arrives. Preparation means pre-commitment. It means having liquidity before you need it. You can do this personally by holding a cash buffer and deciding in advance when you'll deploy it. For example, if valuations drop below a certain level or market sentiment hits extreme pessimism, commit to buy in 3 stages over a few months. Planning removes the emotional chaos that comes with a crisis. Every bubble begins with a story. In the 1990s, it was the internet. In 2020, it was crypto, electric vehicles, and blank check companies. Today, it's artificial intelligence. These trends are real and transformative, but the narrative that it's different this time often leads to ruin. The internet did change the world, but most early investors still lost money because the companies had bad business models and no profits. The lesson is timeless. Innovation does not equal investment success. Believe in the technology, but only invest when the economics make sense. Howard Marks built his career on one principle. It's not what you buy, it's what you pay. Success doesn't come from finding the best companies. It comes from buying good companies at fair prices and fair companies at great prices. Paying too much, even for perfection, still destroys value. The difference between speculation and investing is simply the price you demand for risk. One of the most powerful ideas in investing is the negative art, winning by avoiding losers. A manager who stays a little above average every year ends up among the best over decades, not by hitting home runs, but by never striking out. You don't have to chase huge gains. You only need to avoid big losses. That means no fragile balance sheets, no excessive leverage, and no bets you can't survive if they go wrong. Cut off the bottom tail of outcomes, and compounding will take care of the rest. Risk cannot be measured precisely. It's not a number on a dashboard. It's the chance that you're wrong about the future. You can't measure it before or after the fact. What you can do is design systems that survive surprise. Keep enough liquidity to live through a bad year. Diversify across business models, not just tickers. Define how much you're willing to lose before you start. Arrange your finances so that a single mistake can't destroy everything. The objective isn't to measure risk, it's to be resilient when risk shows up. Emotion is the enemy of long-term returns. When prices rise, optimism takes over and people buy too late. When prices fall, fear drives them to sell too soon. The crowd always does the wrong thing at the wrong time. Emotionally driven investors buy high and sell low. To break that pattern, create structure. Write down your reasoning every time you buy or sell. When the market turns against you, read your notes before reacting. Courage isn't about being fearless. It's about doing the right thing even when you're scared. Confidence gets you started, but humility keeps you alive. Peter Bernstein once said, "Survival is where the winners are, and survival begins with humility." You can't win if you don't stay in the game. The investor who believes they know everything is already in danger. The market exists to remind us that we don't. Accepting uncertainty is a competitive advantage. You can't control outcomes, but you can control exposure. Know what you don't know and size your bets accordingly. In the age of artificial intelligence, information is everywhere. Algorithms can process more data in a second than humans can in a lifetime. But quantitative information about the present can't make you a great investor because everyone has it. The real edge comes from judgment, evaluating management quality, culture, and strategic endurance. Machines can analyze the past, but they can't yet judge the future. AI will replace careless analysis, not thoughtful decision-making. Here's a simple, cycle-aware playbook. When markets are hot and speculative, raise quality and increase cash. Focus on companies with solid cash flow and durable advantages. When markets are neutral, stay balanced. Hold both growth and defensive assets. Don't stretch for returns. When markets are cold and pessimistic, deploy cash gradually. Upgrade the quality of what you own while prices are low. Remember, the goal isn't to call tops and bottoms. It's to stay consistent and solvent across all conditions. 6 habits can make this discipline practical. First, always keep liquidity. Cash is optionality, not dead money. Second, combine quality and price. One without the other is gambling. Third, protect the downside. Avoid situations that can permanently destroy capital. Fourth, check the market's temperature weekly. Pay attention to behavior, not predictions. Fifth, keep a decision journal to fight emotion. And sixth, stay humble. The moment you think you can't be wrong is usually the moment you are. To outperform, you must be different from the crowd. That means being willing to look wrong for a while. It means buying when others are afraid and selling when they're euphoric. It means staying rational while everyone else is emotional. Great investing isn't about predicting every move. It's about surviving every environment. The next time a market feels irrational, remember this playbook. Don't fight the madness with arrogance. Take its temperature. Adjust your exposure. Protect your capital. And when the fever breaks, be ready to harvest the opportunity. Survive first, compound next. That's the PyUncut way.